about 2 years ago, I had the opportunity to get Bank of America involved in supporting Impact PHL. And I saw it as the kind of the missing link really to what we could offer at at Bank of America in terms of a more national or international focus on ESG, sustainable and impact investing could have another extension for our clients to find a resource, and groups like Intentional Media, Total Impact Conference, Impact PHL have been really at the center for us in Philadelphia of helping to create a platform to really amplify the opportunities that are available beyond the national and the international types of opportunities that we're able to directly involve our clients in across the spectrum. So to me, it seemed like an amazing place for those who live here and those who don't, to be able to find a centering place or a place to learn about the opportunities, to network, to be educated, to learn more about why impact investing is so important.
So great, thank you. Mark?
Yeah, hi everyone. You know, Glenmede was founded back in the 1950s, and it was founded in Philadelphia. And you know, today, the vast majority of our footprint and our employee base continues to be in Philadelphia. So it's a crucial point for us, not only in thinking about investment portfolios, but our duty in delivering value across all stakeholders. So we take a stakeholder-led approach in that we have obligation to our shareholders, our clients, but also our employees and also our community. So, you know, we design holistic investment portfolios for our clients that can align with their values. Certainly from a sustainable impact investment standpoint, this is an effort we formalized about 7 years ago now. It's risen dramatically in terms of the number of clients that are interested to do so, not only with a sleeve of their portfolio, with their entire portfolio, but again, it goes beyond that. It also goes to our testament to our employees, our focus on the Philadelphia region, not only from some of the investments that we target, and we'll talk about some of those today, but also our broader stakeholders, our broader community, and how we can help fuel that forward. And that's always going to be a core tenet of what makes Glenmede great.
So good. Adam, take it away.
Thanks, Heather. Permit Capital is a multi-family office in suburban Philadelphia. We work with families and endowments and foundations, many of whom are in the city of Philadelphia, to build investment portfolios with a core focus on helping families to align their portfolios with their values and organizations to align their portfolios with their missions. So this is something that we have been involved with for probably 15 years now, and there's been an evolution that we've witnessed and taken part in, and we'll talk about that more today in terms of what that means as far as what's actually actionable across a portfolio and within the city of Philadelphia. And as to why it was important to us to provide whatever support we could here, this is a forum, to your point, not about wealth management primarily, but about recognizing what sort of a new normal we're walking into, who the heroes are that are helping us get through this difficult period. And, we don't lead with the fact that we are, investment advisors. We lead with the fact that we are Philadelphians and this is our community. And anything that we can do to help our community in a period of difficulty is going to be important to us. And we think impact investing is something that is always a valuable tool for a community to promote. We think it's needed now more so than ever. To Jamie's point, the work that Impact PHL is something that we have grown an appreciation for. We have tried to contribute to. We are cheering them on. Their success is our success. And having gotten to know you and John over the last few weeks, even though you are not, self-identified Philadelphians, the appreciation for what you're trying to do here with a track record of doing it successfully elsewhere is something that we could easily get behind. We're a pretty parochial group in Philadelphia, but we are generally willing to embrace people who are willing to come in from out of town and try to provide assistance where needed. And, that's kind of how I view your efforts and this conference.
Well, I appreciate that, Adam. It's definitely what we hope to do. And I know that there's a lot of people probably in this room that this is new to them. We hope so, because we hope this conversation is bigger than the ones we've had before. So, Mark, I'm going to take it to you so we traditionally focus on impact investing, and we're focused now on just making an impact in Philadelphia. And to do that, impact investors should understand what impact investing is. So would you help our listeners understand the landscape? It's a complicated place.
Yeah, absolutely. I'm happy to. So I'm going to actually try to share my screen here. So let's see if this works. Here goes. Let me know if
works
you
for
see
me.
this. Great. So even before defining sustainable impact investing, I thought it was important in this forum to just remind everyone the real need on the impact side, just some of the aspects of that and what we're seeing from Philadelphia specifically. And I chose 4 of the United Nations Sustainable Development Goals. For those of you who aren't familiar with them, there's sustainable development goals that have been set in a United Nations supported panel. General goals with a plan by 2030 to address them. So I looked at 4 of these from a Philadelphia regional perspective. And again, just highlighting a few of them. So 1, around the goal of no poverty. And you look at Philadelphia, it's one of the poorest, largest cities in the U.S. with 22% living in poverty today. Good health and well-being, children's life expectancy in the North Philadelphia region of Philadelphia, it's 20 years shorter than children in more affluent areas. So a really interesting point there. One certainly that there's the need for capital there. On the energy side, the 12th most polluted city in the U.S. A very ambitious stated goal by Philadelphia to get to 100% clean energy, but a lot of capital is still needed there. And then on decent work and economic growth, again, one statistic, 68% labor participation in Philadelphia, well below national city averages. One other point, I'm sure everyone on this line is thinking this, COVID-19 has amplified these further, certainly from a labor participation, certainly from health and wellness. So COVID-19, if anything, has amplified the need for capital in a lot of these regions, something that all of us on this panel are thinking about. So how do you help address those areas? Level setting around what sustainable and impact investing is, think of it as a broad spectrum of approaches. This is not a space that's one size fits all, but it is a space that enables you in a way uniquely now that you couldn't do 10, 15 years ago to design an entire portfolio around either this concept of sustainable investing, which is simply about using sets of environmental, social and governance information to help you make better investment decisions, while also looking at impact investing, which is this idea, again, of looking at that information, but your goal is really to make a measurable targeted impact. And sometimes you can do both, which is why this is portrayed as one box. It's a spectrum of approaches. We like to think about it from the way a lot of our clients think about it, which is portfolio goals. Do I want to mitigate some of the risks in my portfolio? Do I want to position towards some of the opportunities for growth going forward? Or do I really want to create impact? And you can do a mix of all those things across a portfolio. This is the broader spectrum of approach in terms of the different ways that you can look to design portfolios. And again, we like to think at Glenmede, we work with private individuals, we work with family offices, endowments, foundations, and institutional investors to design entire portfolios that have aspects of sustainability or impact throughout. So on one end of the spectrum, we have this idea of ESG integration, which is simply considering these ESG factors right alongside your traditional factors. As you move right, you become targeted in some of the impact areas that you're looking to address. So ESG mandated is using specific tilts in your portfolio where you're making sure that you are gravitating towards those highest quality names. Thematic goes one step further by identifying specific environmental or social goals that could have been some of those ones I referenced earlier to design a whole portfolio around accessing those. Very importantly, the first 3 categories, they all seek market rate returns alongside that impact. The right-hand side is really the lone category where your primary goal is impact, and there's a willingness to sacrifice returns to achieve that. Not necessarily something that you have to, but a willingness to do so. One last page, just to level set and give the audience a sense of the amazing spectrum of opportunities that do exist in Philadelphia, there are ways to create entire portfolios across public and private markets across these approaches that's dedicated to Philadelphia and helps address some of those impact areas we mentioned earlier. So areas like ESG mandated, a really strong set of venture capital firms exist in Philadelphia with a dedication to Philadelphia-based startups within that. A number of things you can do in the credit spectrum with giving small business loans to organizations that need it most. On the public markets, this is something that a lot of times clients are surprised that you're able to do this, but you are able to design specific customized portfolios around public companies that are either based in Philadelphia or serve a real need to Philadelphia. And that's really interesting. You shift to a thematic, you get more targeted again, looking at some of those environmental or social goals. How can you look to actually privately, earmark capital for those needs? And on the public markets, municipal bonds, we were looking at a municipal bond in North Philadelphia that benefited a health and wellness need that's very great in that region. And then finally, concessionary high impact, again, very, very clear that this is not necessarily something that you have to give up returns. There's a willingness to give up returns, but that's not always the case. There's a number of things we've seen emerge even in the last couple of months that specifically address some of the needs created by COVID-19, whether it's some of the daycare funding loan programs we've seen come out, some of the payroll protection programs, really interesting things that, again, from a very near-term urgency perspective, it's important to allocate capital today to those needs to a lot of our clients. So I'll pause there. Hopefully that gives everyone a sense of the spectrum, the real need, and the idea that you can seek to build entire portfolios around these areas. I'm going to stop sharing now.
So great. Thank you, Mark. That's very comprehensive. And I hope there's questions about it. Please, if you have specific questions, want clarity on any of that, please put them in the chat. We'll get to them at the end. And I want to turn the conversation over to Jamie at Bank of America has recently written some interesting thought pieces on responsible investing. Could you share with us how you feel investors have fared this past year who have a commitment to responsible investing?
America is the total of Merrill Lynch and Bank of America. I'll go back. I think I was muted. I think I should be all right now. Bank of America has both Merrill Lynch and the Bank of America private bank under its umbrella, and we are able to benefit through what is now branded as the Bank of America research team, formerly through Merrill Lynch. We've got a industry-leading ESG analyst, #1 rated institutional analyst on ESG research, Savita Subramanian. Savita has been a quantitative research analyst at Merrill or Bank of America for many years, and over the last 2.5 years had the really strong realization in her quantitative work that ESG was both very powerful to reduce risk in securities that you invest in, companies that you invest in, identifying risk, but also that companies that led with their ESG profiles tended to be better performers financially, both at a company level and at a stock price level. They had better access to credit. Their stocks tended to do better. Their employees seemed happier. There seemed to be a number of things. So over the past 2.5 years, we've developed we've got a ESG Matters is the name of the thematic research that we put out. And what's been really interesting is up until COVID-19, we were in the midst of one of the longest, greatest bull markets in history. And I'll get to your direct answer in a second, but if we look backwards a year, we saw that ESG had outperformed non-ESG investing. And for those of you who are new to this, I'll take a step back and say, that's really just the consideration of using environmental, social, and governance factors to make your decisions around your investments versus not considering environmental, social, and governance factors, which we would say is traditional investing today. We think that by using environmental, social, governance factors, you're a better informed investor. You know more about what you're investing in because you understand those characteristics of a company. So with that basis, the data that has over the past decade that has risen in the industry to provide us that information created an opportunity for investors to have better information in the bull market to invest in companies that were positioning themselves better relative to their peers on the environmental, social, governance spectrum. Therefore, they were not only outperforming their peers, those who had a higher score in those categories were doing better in their stock price, but they were also doing better fundamentally as a company, as a financial operations, access to capital and credit essential to grow their businesses was less expensive because they were a more financially strong company. So you could argue they were a less risky company. A lot of noise has been made or was made around, is ESG a phenomenon that only works in a market that's lifting a lot of sectors, a lot of stocks? Markets, again, had very, very strong runs for the duration of this bull market. But what would happen when the pandemic hit, and what would happen is ESG still valuable to investors? And I've attached, or you've attached one of our research pieces in the file, and you can explain how to access that maybe. And it's entitled, is ESG, I'm paraphrasing, is it a bull market phenomenon? Quite the contrary. So directly to answer your question, what we've seen this year through the first quarter is that investments made with an ESG perspective are dramatically outperforming those that aren't. If we look at performance within a sector, the highest performing ESG companies are outperforming the lowest ESG rated companies in that sector at the time of this research report, anywhere from 5 to 10% year to date. So extremely meaningful, both outperformance, but one thing we've also found is that the companies that score the highest when you consider ESG are also the least risky companies in their sectors and tend to have the strongest balance sheets. So some data to support this. During the first quarter of this year, no financial sector had positive cash inflows into it other than ESG investing. For example, if you were to buy the S&P 500 index versus the S&P 500 ESG index, of which there are several, the only sector of investment that gained assets in the first quarter globally this year were those investments that had an ESG focus. So not only, and every other sector of investment in the first quarter actually had negative outflows of cash, going to cash. So we're seeing this also as a place where investors feel like they can be less risky because they're investing in better owned, operated companies. Final point I'll make that this research points out, which is quite interesting. The companies that are actually doing the best this year are those companies that that have a high performance in the social category. They've got a very high employee satisfaction. They've got employee resiliency in the form of benefits, all sorts of benefits and services that these employees can utilize during the times of pandemics. Their brand reputation is socially very strong and has remained strong. Some of these companies have gotten even stronger through this pandemic. So the social factor, unlike in 2008, it was a crisis of governance, and governance was the biggest factor. In this current crisis in the markets, companies that have positioned themselves to best serve their community and their employees are the ones doing the best. Sorry to be a little long-winded, but I think that sets the tone for companies that are considering this, whether they be in Philadelphia, in the country, or outside of our country, are performing the best. Every company, and we have the great resource of B Lab and B Corp in this area, which Impact PHL has been a partner to, can focus more about their environmental social governance process and presence, and they will do better because of it. And this research and all research really in the ESG space now is concluding kind of these same conclusions.
Which is incredible, and about time. We've known for a long time that good business was good business, and now we have proof of that. And so how do we move forward and build portfolios accordingly across the board? So I know, Adam, you have been a champion of responsible investing over the years. What advice would you give to people who want to learn more about this, both as investors, they maybe want to have a career in this, or perhaps there's something additional that you think should be touched on as we dive into this important conversation?
Yeah, and I'm going to answer that through a place-based prism, since we're talking primarily about Philadelphia here, and since we've all spoken about the need to get more impact capital into Philadelphia. And I would say the first thing to do, whether you want to participate as an investor or a member of the impact investment community itself, is to get involved in the community. At the end of the day, impact investing in a city like Philadelphia is understanding how to provide access to capital for individuals and communities that don't have the same access to capital as others do. And I think Philadelphia, we have our challenges, but one of the things that we have going for us is a very, very robust nonprofit community. And I think taking the time to, spend time within the nonprofit community and giving to nonprofits and joining boards and going to events and meeting others and meeting the leaders in the nonprofit community is a great foundation to understand how impact investment in Philadelphia can and should work. I mean, some of the more interesting opportunities that we have developed for our clients have been born out of participation in nonprofit organizations that we, as members of Permit Capital, participate in. And sometimes there is a ready-made opportunity to invest. Sometimes what we've done is, almost what I would call a reverse engineer process. So if there is a nonprofit that we are working for, or a nonprofit that one of our clients wants to support, we will spend some time with that nonprofit, understand their balance sheet, their income statement, their challenges, and look for ways to structure an investment, whether it be a low interest loan or perhaps cheap equity capital, and structure an investment that can effectively serve as another source of revenue for that nonprofit. And it's not just important as it pertains to sourcing impact investments in a portfolio. Oftentimes it impacts how you would do due diligence on an opportunity, the decision to go or to pass on an opportunity, the decision how to size an impact investment opportunity is born from understanding the foundation of the nonprofit community. And, as it pertains to portfolio construction, we recently wrote a piece that we posted on the site here that we call, the impact efficient frontier. And it's a derivative of a term in traditional investing known as an efficient frontier, in which every investment has a point of efficiency where the return comes together with the level of risk being taken. And if you can find one where the return and the risk are well calibrated, presumably it's a viable component in a portfolio. What's interesting about impact or mission aligned investment is we think about return differently, but we also think about risk differently. One of the risks to an impact investment or a mission aligned investment is that at the end of the day, it's not going to turn out to further or propagate the mission. So the return that we try to chart as it pertains to impact investing is the tightness of the alignment to an organization's mission. One of the byproducts of that is it forces us to work very closely with our clients because it becomes a very collaborative exercise. So working with the programming, community within a foundation, working with the grant making decision makers, and understanding just how tightly aligned a prospective investment is with the mission of the organization is an important part of the process. The Holy Grail, if you can find an investment that's likely to produce a reasonable return, market level or otherwise, that would also be appropriate as a donation or as a grant, then that is something that can be sized in a meaningful way in a portfolio. If you have an investment that is core to the mission of an organization, but it is riskier in a portfolio construct, it still may very well be worth making that investment, because if you're not willing to take that sort of risk, then you're probably not going to do as much good with your capital as you might otherwise, but it might deserve a smaller allocation. On the other side, if you have an investment that is impact related, might be a safe investment, but isn't particularly well aligned with the mission, that might deserve an allocation as well. But that too might be a smaller allocation. So, my point in all of this is to really understand the impact investment landscape. I think it would behoove you to really jump into the nonprofit community in Philadelphia. There's always a way to do so. There's always a need to do so. Nobody is going to turn you away when you say that you want to learn more about their organization because you want to find ways that you can help them. And I think ultimately, Mark talked about the continuum of investments from public securities to private securities on both the debt and the equity side. And in some cases, to make the really impactful investments, you have to look at private investments that you're not going to necessarily find available, but that you have to create as an organization or as an investor. And to understand where the needs are and where the capital, isn't flowing, I think spending time within the nonprofit community is a great way to learn.
Awesome. Amazing. So I think we've actually heard a lot of that kind of theme and intention throughout our conference of needing to come back to the people whom you are trying to impact with your capital. If you're out of touch with the people whom you're trying to help, that disconnect is not going to serve everybody. And so that's the first step, I guess. And I really appreciate that. I want to kind of go in another direction. I have a follow me for a story kind of moment. I feel, so we have 3 very different institutions being represented here, all involved in responsible investing. And I feel like Goldilocks and the 3 bears in this discussion. And I want to find the advice that's just right for me, just right for my risk, just right for my portfolio. There's a large Bank of America with all its resources and security where I could get my porridge, or I could go to Glenmede with its regional history and legacy, and I could sit on its rocking chair. Or I could go to Permit Capital, an agile and bespoke independent firm where I could maybe jump on their bed. We all know one size does not fit all, and each of your firms has a different advantage. As leading investors and champions in this field, can each of you give some insights into what Goldilocks should consider when searching for an advisor? I'm going to go the other direction, and I'm going to pop it over to Adam.
As you said, Permit, we manage north of $1 billion in assets, but certainly relative to Glenmede and Bank of America, we do have more of a boutique type feel. And I think that has a couple of advantages. One, we are able to spend time with clients and structure investments that might only be, appropriate for a single investor. And we have kind of the banking background to structure both debt and equity investments, but also a willingness to work with clients to build a portfolio that is customized to the footprint that they want to lay within the Philadelphia region. That also allows us to, I talked earlier about the importance of supporting the community where capital is needed most. And sometimes, there are entrepreneurs in the city of Philadelphia where we believe there is a significant amount of leverage that they're going to create. In other words, they may be looking to create an incubator, or they may be looking to create workspace for other minority entrepreneurs. And oftentimes the amount of capital that they're looking for can be modest. It can be $300,000, $400,000, $500,000. And, with a client base of $1 billion, a $500,000 investment that a entrepreneur needs to grow a business to then hire on other entrepreneurs is something that we're willing to roll up our sleeves and spend time on. If it's going to do good, there's really no project, too small. And while in total, I think the capital that is needed in Philadelphia, that's massive, the most efficient way to direct it isn't necessarily through a wide funnel, but rather a series of more narrow arteries. And I think being able to both find those arteries and create investments that are more odd lot in nature, so not necessarily always deploying capital in the millions or the tens of millions of dollars, but finding that coffee shop in the minority community that's going to close if they don't get a bridge loan program put in place for $25,000 or $50,000. That might be a staple in the community, whose loss would be felt by the community if it doesn't have a bridge to the other side of this, is important, and I think has a multiplier effect. One of the things that we do with some of our clients is we create a bridge loan program that's customized for their grant recipients. So we have foundations that are supporting organizations that might be dependent upon capital, that might now be slowed in the current environment, either because it was coming from a capital campaign that's been delayed, or it's coming from a government program that might be taking a backseat to another government program. We will do underwriting for our clients to make grants, or to make loans rather, instead of grants, to those organizations that might just be $5,000 or $10,000 or $20,000. And to a single organization, that might be the difference between success and failure, between life and extinction. And I think being an organization that takes the time to recognize when a $10,000, $20,000, $50,000 loan is going to be meaningful for the community, and having both the institutional capacity to curate that, but also the willingness to be able to do so is one of the distinguishing features, I would say, of working with an organization like Permit in a city like Philadelphia.
Amazing. Awesome. Thank you for that, Adam. Mark, I'm going to turn it over to you. Tell me what you would tell Goldilocks.
Sure. With Glenmede, it's a mix of what I would call three factors that makes us really stand out. The first is our history, and to the extent that we've had this local footprint in Philadelphia for so long. And I talked about this at the beginning, but I thought what Adam said earlier around nonprofits was spot on and really smart. And it's something that we take very seriously as well. We do think that we have an edge in general, given how long we've been in the region, and given how closely we're involved with a lot of nonprofits, even as our clients, that we are able to provide really unique opportunities and be hands-on in that way that maybe some others cannot. On the size front, it's something that we've been really careful about, in that we've tried to hit almost a sweet spot in our mind where we're at a point where we believe we have the scale and the bandwidth to work with clients across types and to offer that full spectrum of opportunities across the approaches I detailed earlier. But we also want to make sure that we still are able to be really high touch and customized as well. We have about 420 employees, so it's certainly not small per se. But when you think about that, and from the standpoint of that, we have been around for about 60 years. We have about 40 billion in AUM. It actually is on purpose this right-sized team of individuals with things we believe makes us nimble and ability to still innovate and generate new ideas. And I think, when you look at Glenmede's overall mission statement, a lot of it talks about how we were founded on ideals, which is back from the 1950s around a mission-aligned organization. Our first client actually was a series of the Pew family charitable trusts. So that was our first client, and still remains a large client today. But the other part of our mission is built on ideas, and we've shown the ability to continually innovate. And one of those ideas, frankly, was to formalize and build out our sustainable and impact investing team, which now is more than 10 dedicated individuals, represents a large portion of our overall client base. So we like to pride ourselves on this almost right size, where have the scale to offer the bandwidth across investor types and across investment types, but also keep small enough to be nimble and to keep moving and to be able to be customized and give clients some of those really interesting nonprofit type opportunities that Adam highlighted as well.
Awesome. Thank you, Mark. So I appreciate your highlighting of the need to be innovative, to be nimble. I think the new normal definitely calls for that. I think that as we move forward, that needs to be valued more and more, because as we enter periods of uncertainty and paving of new pathways, if you're stuck in the old, you're not going anywhere else. I am going, Jamie, I look forward to hearing why your advice to Goldilocks from Bank of America.
Well, I'll start with the organization. At the organization level, I'm extremely proud that Bank of America, in a normal year, will commit over $250 million to community organizations. As a response to COVID, we committed an additional $100 million. Many of the organizations that have been on panels here have received regional funding from us, which is critical. And we've developed, in the spirit of what we've heard from my other two panelists, working with local foundations as a close partner brings us really close to the community. And we can give back both financially, but also through community engagement. We have an amazing presence in community engagement throughout Bank of America in this region. I could go on and on. I was trying to count how many different organizations we've supported this year just in the region, the tri-state region of Southern New Jersey, Philadelphia, and Delaware. And it's significant. And again, a lot of these organizations are partners here in this New Normal Forum conference, and it's really important. Another thing at an organization level is personally my pride to work for Bank of America on a couple of levels. Our environmental commitment, which matters to all of us, is really significant. We have pledged to invest more than the entire Paris Climate Agreement in terms of our own capital into a low carbon future. So as one organization, we have the power to invest billions of dollars in some greater than the entire Paris Climate Agreement, which is 170 countries or so that have agreed to contribute. We as one organization can do that. So I'm really proud of that. I'm really proud of our leadership. We wrote our first ESG report as an organization in 2008. Now it's the bellwether for financial services companies from a reporting standpoint across ESG. It's 125 pages now. It is the playbook for how we operate as a company for responsible growth. And all of that trickles down into the organization to the satisfaction of our employees, the strength of our core business, our resiliency in being a major institution here in these times with great resiliency and great security for our clients in terms of banking with a bank that's going to get through this without really, in my opinion, any question, because of the steps we've taken to prepare ourselves for times like these. Our significant involvement in the PPP program, the countless hours and weekends that we had staff dedicated to getting those applications through, those are things that are really important at a community level. From a professional sort of advisory level, I advise individuals and institutions in the region We have fairly low minimums in terms of working with individuals at Bank of America Private Bank. We're at $1 million individual net worth level, which is high, but for the level of service and opportunity, I think is reasonable. We also have Merrill Lynch. So those clients who don't meet a minimum of that threshold, we can work with on the Merrill Lynch platform at any threshold. And we have CIO led, Chief Investment Office led ESG portfolios, which are turnkey for investors by various thematics that they want to explore, whether it's environment, equality, gender, religious views and values, carbon, low carbon or fossil fuel free. We've got turnkey portfolios for every investor, whether they have $1 million or not. They can be on the Merrill platform or on the Bank of America Private Bank platform. One other thing that I think really differentiates us is 7 years ago, the Bank of America Private Bank started a platform called Socially Innovative Investing. We also believe that the Sustainable Development Goals, the SDGs, are an amazing framework for investors who are looking to allocate their money to have meaning and purpose towards the impact needs of the world. So these 17 SDGs have become the models for our portfolios under our Socially Innovative Investing platform. Right now we have 7 portfolios that directly align to 7 different of the SDGs. Global equality and diversity. We have a specific gender lens portfolio, environmental stewardship, carbon reserve free, religious voice and values, and global sustainability are a number of them. I can also report, in line with kind of my earlier comments about performance, since inception, each of these portfolios is beating its comparative benchmark. And many of these now go back 7 years.
It's not a surprise.
We also operate these portfolios on a separately managed basis so that clients do have some ability to customize around the portfolios that are run under those thematics. So we really are able to, especially in the public markets, bring our clients into a very high impact portfolio. And then I think we have this great intersection with Impact PHL in our region to say, okay, now that you've got a properly aligned, and we are a full fiduciary also, which is another distinguishing factor. We act as fiduciary on behalf of our clients, which is really important at this point of investing. Beyond that, we can design portfolios that are run to an investment policy statement as a fiduciary, but we can identify where in the portfolio might be appropriate assets or spaces to invest that we could deploy capital within this region, where we're not making a trade-off of risk or return to put money right here in Philadelphia, because there are appropriate investments that our other firms and partners in the region are producing, that Impact PHL can help to really bring to the mountaintop, so people, our clients and others, can sort of see, okay, in a well-run portfolio that's asset allocated, how can we also allocate some of these assets right here in this region? And I would say that partnership with Impact PHL as a very large global organization gets us much closer to be able to help our clients who live here and care about investing here.
Awesome. Great. I hope that this left our audience with a little bit deeper of an awareness of the different types of institutions there are, the different types of advisors there are, the different types of, and how many, the variation within this space of impact investing. we have about 10 more minutes left for this conversation. And so I do want to take it into questions. And on the note of Impact PHL, we've had some great questions from our colleagues there. The first of them is from Mike Kozak, and he asks, what do you see as the biggest obstacles in convincing your clients to invest in a sustainable way? I know that's kind of there's a lot of ways that we could take this. So maybe I'll start with Mark.
Sure. So the two biggest obstacles.
Oh, before you go, be like maybe 1 minute answers.
Got it. Two biggest obstacles in 1 minute. First, I would say measurement. The ability to link tangible impact outcomes across a portfolio with financial returns. I think there's been a lot of developments in the last few years that have made it easier to do that, but rightfully clients say, I really care about these impact issues. I've just allocated this capital across a number of different ways. Show me how this is actually causing that impact. It's hard to standardize that because there's many different ways to slice this, and there's lots of different ways that underlying managers report this. That's ongoing. The other one is, I would say there is still continued skepticism around the link between strong risk-adjusted returns and making impactful investments. I think Jamie laid out a number of really compelling points around the performance over time. We've seen the same and have seen really strong characteristics emerge in the last few months around these strategies holding up amidst COVID. I just think more education is needed around that. The more data points, the better. And as more and more strategies have 3, 4, 5, 6-year track records in this space, that's getting a little bit easier. But that is still an obstacle that we face in some meetings.
Great. Jamie, I'm turning it over to you.
Education, really, education that there's no financial trade-off. There's still a misconception that there's a financial trade-off. Belief that product can be accessed to, which is part of education. I think there's a view that as an individual investor, you don't really have these opportunities to make impactful investments, where you really do. And then again, on education, allowing shareholders to know that they can actually vote on shareholder resolutions and proxies, and actually make their vote count around environmental, social issues, governance issues within the organizations. So education is, to me, the biggest barrier. Also advisors. There just aren't, we three know enough about this space to help our clients at a very high level and a very deep level. There aren't that many advisors in the broad scheme who understand sustainable ESG investing yet, but that tide is turning rapidly. I'll close there.
Great, thank you. Adam, take it away.
Well, I think one of the barriers is having an appropriate vehicle to invest through. While investing in impact opportunities is not inherently more risky, in fact, as Jamie pointed out, relative to similar types of investments, it can often be less risky. However, as we've all stated, oftentimes to make the most investment, you're talking about allocating capital to very early stage businesses, and that carries with it inherent risk. And one way to ameliorate is to have appropriate diversification. In order to have diversification, you need to have some sort of an appropriate fund structure. And, while there are, options out there, we think that there are a couple of gaps in the landscape. We think that in Philadelphia specifically, there is a need for more equity capital. There are a lot of great debt providers and CDFIs. So we think putting together a commingled vehicle that allocates to some of the earlier stage equity opportunities that I discussed would be beneficial in Philadelphia. It's one of the reasons, frankly, that we have spent some time, with 17 Asset Management, because you have experience building city-based and place-based funds in other locales. And we want to be able to take that and that experience that you've had in other parts of the country and other parts of the world and bring it to Philadelphia. So I think having an appropriate Philadelphia-based fund with an equity bent to it will not only allow investors who may have significant capital to deploy to have the confidence to do so, but it will provide a catalytic opportunity for smaller investors and smaller foundations to have a vehicle that they can get diversification in fairly quick fashion.
Great. We couldn't agree more. I am grateful for the shout out to the conversations that we've had between 17 Asset Management and Permit Capital in order to really align our mission with the impact that we want to have. It starts with understanding. And that is a large reason why we are as involved with this conversation and this conference as we are, because we want to have this conversation. Let's take it to another question. We'll try to keep this one fast, although it is a little longer. And it is also from another colleague of ours at Impact PHL, Corey Donovan. And so he asks, for those who want to move in this direction with their own financial assets, how best do they engage with their financial advisors in that discussion? What do they say? What questions do they ask? And how do they evaluate early progress? So that's a big one. Maybe I will give you 1.5 minutes and then we'll wrap it up. I will give you guys a second to think. Jamie, do you want to take it away?
Sure. You have to ask the question, can I begin to do ESG investing with you? And from a taxonomy standpoint, ESG is a good descriptive term for considering those things in your investment: sustainable investing or impact investing. They're all slightly different, as we talked about the landscape earlier, but making sure that that advisor understands that's important to you. We use a discovery questionnaire, which is extremely helpful, which allows us to hone in on the specific thematics that the client wants to explore, and then we go into portfolio diligence and construction from there. So I'll be happy to share the questionnaire, and if you want to put it up on the link as a future reference. But I think something like using a questionnaire or those types of questions to ask an advisor if they can help you in that regard. And if they can't, you need to search for an advisor who can. Mm-hmm. And then there is the follow-up issue of how do you know if it's working? There is very, very good data now around being able to benchmark for ESG and non-ESG, obviously financial performance, but really the impact metrics and the reporting around that is getting better and better, both in the public market and the private market. So depending on what firm you're working with, there are impact scorecards that you can get on your portfolio. I deliver those on a quarterly basis to my clients and takes them through what a portfolio snapshot and the impact scorecard. So stuff there.
Awesome. I am going to take it over to Adam.
Thanks, Heather. Investing is inherently a very personal exercise, and that's whether it is impact related or not. But more so clearly in impact investing, when you're trying to align your portfolio with your missions or your values, it's a very personal conversation. So, that's why all of us, myself, Jamie, Mark, part of what we do requires an analytical framework. Part of what we do requires a psychological framework. So I think, making sure that you have an advisor who's going to talk to you, who's going to listen to you, who's not going to tell you what's right for you, but's going to digest what they hear from you and then collaboratively come up with a pathway forward. We believe that it is not our job, effectively we see ourselves as risk managers. It is not our job to tell a client how much risk to take, because again, that's personal, but it's our job to make sure that a client is able to identify the various risks involved with a particular course of action. And that's both the obvious risks, the active risks, but also the passive risk, including not taking on enough risk. So I think making sure that your advisor is asking you the right questions, making sure that they're listening to you, making sure that they are not trying to put you into a box where one size fits all, I think is really important in investing in general. And in particular, it's important in a mission-aligned framework.
Awesome. Perfect. In the last minute, Mark, want to take it away?
Yeah, and I'll be quick. We too use a questionnaire-based approach. Ours really is rooted before we get into any of the slang and terminology and SRI versus green or sustainable or impact. It's really around motivations, and it's around what do you want to achieve by incorporating ESG? Is it just to make sure you're avoiding some of those poor ESG names that can cause some shocks to your portfolio? Is it to unlock some of those growth opportunities that are created by really highly impactful, high ESG quality companies going forward? Or is it, again, to make targeted, local, measurable impact that we've talked about here? And if you can tease that out early on, you immediately are above and beyond most of your peer group. By being able to understand that, you're then able to get into this matching those motivations with ESG integrated versus mandated versus thematic, matching to what their core impact goals are, and designing a portfolio that, again, I think both Adam and Jamie said this, it's iterative. It's not one size fits all. It's not just sending them a product and saying, hey, this has ESG in the name. This is a ESG product. It's around designing something that meets those core motivations. And that's the crucial standpoint, and being crystal clear on the different ways to approach it and the definitions around it.
I really think that is a great note to end on, because I do think motivations are what matter. And I think our motivations are changing. I think our values are becoming more and more important in our decisions that we make and the actions that we take. And I look forward to seeing how this industry grows. And I am grateful for all of you leading the way in its evolution. With that, I want to thank you all for your time and invite everyone that's watching to join us at the happy hour. Starts in 1 minute, and we'll wrap up there.
Thank you.
Awesome. Thank you, guys. Thank you, Jamie, Mark, and Adam.